Hi guys and welcome to the new video of Nova Forex. As we all know that the retail investors always desires of knowing the areas at which the smart money enters the market in order to get huge profits by entering from those areas. So, in this video we would reveal the concepts which is used by the central banks and big institutions in order to enter into the market. And by using these concepts, you can maximize your profits by entering into the smart money entry areas. But before we start the video, make sure that you subscribe to our channel and hit this bell icon as we upload new and effective smart money trading video every week. The key concepts that we are going to reveal in this video are necessary for you to learn in order to know the smart money entry areas in the market. So, the concepts are break in market structure, shift in market structure, imbalance, order block, inefficiency, and liquidity. Let us begin the video with the first concept, which is break in market structure. The break in market structure occurs when in a bullish scenario, the price breaks its recent higher high to the upside. And in a bearish scenario, the break in market structure occurs when the price breaks its recent lower low to the downside. The break in market structure is a sign of market continuation wherein many traders initiate their trades in the market. Let us see one example of such a type of trade. So, as you can see here, that the market is in a strong uptrend. And as you can see here, that the market has broken its recent higher high to the upside, which is why we would initiate a buy position here. And as you can see that we made a nice 3:1 risk to reward ratio through this trade. Same happens in the bearish scenario. So, as you can see here, that the market is in a downtrend. Here we can see that the market has broken its recent lower low to the downside, which is why we would initiate a short position here. And as you can see that we made a nice 3:1 risk to reward ratio. The second key concept is shift in market structure, which traders usually call change of character. The shift in market structure occurs when in a bullish scenario, the market breaks its higher low to form a lower high, or in a bearish scenario, the market breaks its lower high to the upside. The shift in market structure is a sign of reversal. Let us now learn how to trade using shift in market structure. So, as you can see here, that the market is doing the break of structure to the upside, which indicates that the market is in a strong uptrend. And then we can see market breaking its higher low to the downside, which we say shift in market structure. Now we would wait for the price to reach at this zone in order to initiate our short trade. And as you can see that the market reached at this point, and thus we would initiate a short trade here. And as you can see that we made a nice 3:1 risk to reward ratio through this trade. Now let us look at one more example. We can see price making the break of structure to the downside, which is why we can say that the market is in a strong downtrend, and then we see market breaking its lower high to the upside, which we call shift in market structure. Now we would wait for the price to reach at the zone in order to initiate a short position. Here is our entry point. And as you can see that we made a nice 3:1 risk to reward ratio. The third key concept is imbalance. The imbalance candles forms when there is an imbalance between buyers and sellers in the market. Basically, imbalance means big candles like this, which market usually forms when the smart money enters into the market. The imbalance candle forms a big gap between its previous and next candle, which we call fair value gap. Most of the times the price comes to this zone in order to fill the fair value gap. Let us learn this with an example. So, as you can see here, that the market formed a big green candle, which we call an imbalance candle. Now we would wait for the price to reach at the fair value gap, which is created by the imbalance candle. Here is our entry point. And as you can see that we made a nice 3:1 risk to reward ratio through this trade. Similarly, as you can see here, that the market formed a big red candle, which we call an imbalance candle. Now we would wait for the price to reach at the fair value gap zone, which is created by the imbalance candle, in order to initiate our short trade. Here is our entry point. And as you can see here, that we made a nice 3:1 risk to reward ratio. The fourth key concept, which is necessary to learn in order to know the areas at which the smart money enters the market, is the order block. The order blocks are refined areas of supply and demand. The order blocks usually forms in the market when the market makes an imbalance candle. The previous candle of the imbalance candle is considered as an order block zone. The imbalance candle is formed because of the huge orders placed by the smart money, which is big banks and financial institutions. The smart money brings the price again to this order block zone in order to fulfill their unfulfilled orders. Let us learn this concept with an example. So, as you can see here, that the market is in a strong uptrend as it is continuously breaking its structure to the upside. We can see market forming an imbalance candle after the first bullish candle, which is why we would plot a bullish order block zone from this candle. And now we would wait for the price to reach at this zone in order to initiate a buy trade. Here is our entry point as the price reached to the zone again. We would keep our risk to reward ratio at 3:1. And as you can see that we ended up making up a profitable trade. Now let us look at an example of bearish scenario. So, as you can see here, that the market is breaking its structure to the downside, which indicates that the market is in a strong downtrend. We can see market forming an imbalance candle after a weak bullish candle, which is why we would plot a bearish order block zone from this candle. And then we would wait for the price to reach at the order block zone in order to initiate a short position in the market. Here is our entry point as the price reached at the bearish order block zone. And as you can see that we ended up making up a profitable trade. We would reveal more strategies about the order blocks in our upcoming videos. The fifth concept that we are going to discuss in this video is inefficiency. The inefficiency basically means the gap between the previous and next candle of the imbalance candle. When the market makes such type of big gap, then it is said to be inefficient. The price usually comes back to this zone in order to fill this inefficiency. So, in a bullish scenario, we would wait for the price to come back to this zone in order to initiate our buy trade. Similarly, in a bearish scenario, we would wait for the price to come back to this zone in order to initiate a short position. Now let us move at the last key concept of this video, which is liquidity. The liquidity is an area where the market forms equal highs and equal lows, or both. The liquidity is formed by the smart money in order to trap the retail investors. Let us understand how to trade using liquidity and also how to avoid from getting into these traps. Let us assume that we are in an uptrend. And the smart money wants to buy 10 million shares of the currency pair. They could not do so because no one wants to sell as the market is in an uptrend. So, they would create a liquidity zone of equal highs and equal lows. And then they would sweep the liquidity to the downside in order to make the retail investors realize that the uptrend has ended and a reversal may occur very soon. The retail investors would enter into a short position when they see this big red imbalance candle forming after the market swept the liquidity. And as you can see that the market grabbed all its liquidity and moved upwards. And this resulted in hitting the stop loss of the retail investors, and this is how they get trapped. Let us understand this with one more example in order to understand it properly. So, as you can see here, that the market is in a downtrend. Then we see price forming a liquidity zone as it created equal highs and equal lows. We can see market sweeping the liquidity zone to the upside. At this point, the retail investors would think that the downtrend has ended and a reversal may occur very soon. And after seeing the market forming this big green candle, the retail investors would initiate their buy trade. But the market grabbed all its liquidity and continued its downtrend, which resulted into hitting the stop loss of the retail trader. And this is how the retail investors gets trapped. This brings us to the end of this video. So, in this video we learned the key concepts that would help us in knowing the areas where the smart money enters the market. If you found this video useful, then don't forget to like the video. And make sure that you subscribe to the channel and hit this bell icon as we upload new video every week.